Hello, everyone. Welcome back to my channel. So, in this episode, I'm going to go over chart patterns. So, in previous episodes, I would have explained trend lines and how to draw them and candlestick patterns. So, once you have all that knowledge in your toolbox, you can then go ahead and now draw chart patterns. Now, I don't always use this strategy in trading, but I think it's very good for you to know it because you can line up chart patterns with other confluences in the market, so it'll help you form a decision of which way the market's going to go. So a chart pattern is a shape within a price chart that helps to suggest what prices might do next based on what they have done in the past. So there are three different types of chart patterns. There is the continuation pattern, reversal pattern, and bilateral patterns. Chart patterns are not a guarantee that the market will move in that direction. It's merely an indication of what might happen to an asset's price. So, this is the fourth lesson that I've done in the trading series. And I'd advise you start back in lesson one because this episode will make a lot more sense. Okay, let's dive in. So, in the screen here, I have a double bottom and a double top. So, I'll go over the double bottom first. So, you have price action coming down, and it hits a level of interest for traders and it gets bought up. As you see, then it actually reverses, sells off again, and comes back down. And roughly around the same area where it's bought up before, it gets bought up again, and then we have a complete breakout there where the price shoots back up. So this would be a reversal pattern. It's very common. You see it quite a lot, and it's definitely one to look out for. So how traders would trade this they'd wait if they'd see the price action coming down, they're waiting for a reversal. They see that they get a double bottom, and then so where they draw this neckline. So as the price breaks out through the neckline, they would long or and put in their stop loss underneath the bottom of the reversal. And then on the flip side, then we have the inverse. It's like the inverse of the double bottom. We have the double top. So you see, price is going upwards. It gets stopped out here and it gets sold off. Price sells off, bounces again, and puts in a double top, and then it completely sells off. And you see, you can draw your neckline here. And again, how traders would use this they would once the price breaks out through the neckline, then they could put in a short sell, and it predicts that it's a complete reversal in the market, and the price will completely sell off. So this is an example of a double top in a market. So you'd have price rising up here, puts in a high, gets sold off, bounces on the neckline here, and buyers come back in and they try to push the price up higher, but they just can't keep the momentum, puts in a double top, and then it just completely sells off. So here we have an example of a double bottom. So it's the inverse of what I just previously showed you. You have the market selling off here, and it's in a downtrend, and it finds a line of interest, a support line, and it bounces, gets sold off again, finds more support, more buyers come in the market, and it just completely reverses the trend. And as you can see, then it changes and it starts an uptrend. So what you have to look out here is just a double bottom, or some people call it a W and an M. So let's just say this would be an M pattern, and this would be a W pattern. But they're commonly known as double tops or double bottoms. Okay, so at any stage, just pause the video, take out your trading journal, make a quick sketch, so it'll help you remember. I'm going to go through quite a few of them here, and they're quite useful to understand and use in your trading practices. Okay, so next up here is a head and shoulders pattern. Again, this is a reversal pattern, So you do quite see these quite a lot. So it's very similar to a double bottom, except this is the left shoulder, the head, the right shoulder. So you have an uptrend, and price then is topping out here, puts in the left shoulder, head, right shoulder, and then you have your neckline here. And then once it breaks the neckline, it's a breakout and it's a trend reversal. So here you have the inverse head and shoulders. So it's very similar, except we have a downtrend. The price then finds support, consolidates, puts in a left shoulder, a head, and a right shoulder. And then you can draw your neckline across here. So this would be a resistance line. And eventually then the price breaks out the neckline. So then it's a complete trend reversal and price shoots up. Okay, so this is an example of a head and shoulders pattern drawn on a chart. So they're easy enough they're very easy enough to identify on the chart. So as you can see, here is an example. So this is the price action where it shoots up, forms the left shoulder, forms the head and the right shoulder. And then as you can see, the price then is reversing, so coming down. And now here is an example of an inverse head and shoulder in the chart. So again, it comes down, price forms the left shoulder, the head, the right shoulder, and again, you can draw then the neckline. And once the price breaks through the neckline, then this is a valid pattern, and you can see that the trend is then reversed and price shoots upwards. So a head and shoulders pattern is only validated when it breaks the neckline and puts in the left shoulder, head, and the right shoulder. So next up, we have a cup and handle. And out of all the patterns I'm showing you today, this is probably one of my favorites because it has a high success rate. And if I see it in the charts, I usually put on a trade because, as you can see in this diagram here, a pattern like this can take up to one month to 6 months to form this cup. So usually it's a bullish pattern. So you'd have an uptrend, and then the price then would retrace over a couple of months and form this kind of a cup shape. And until then it hits resistance and it breaks down again, forming the handle of the cup. So usually the handle would be 1/3 or 1/2 the depth of this cup. So if you put in a measuring tool and you measured, let's say, from here to the depth of the cup, so the handle would retrace about 1/3 or 1/2. It wouldn't any more than 1/2. I would just cut the trade. It wouldn't be worth it. And yeah, so I'll explain in a further detail here. So again, with the cup and handle, you can also have the inverted cup and handle. Now, rarely do I see an inverted cup and handle. I'm sure there are cases where you do find them, but for me, it's more common for me to see a cup and handle as opposed to the inverted cup and handle. So in the diagram here, you can see the price forms a channel here. So it breaks down, has lower lows, lower highs. So you can draw your trend lines here. And how traders would trade this is they would either put in a long once it breaks this trend line or once it breaks the neckline. So there's a few ways to trade it there. And then you'd obviously put your stop loss underneath this trend line here. And it's the opposite goes to the inverted cup and handle. So you have your cup here that's inverted, your handle, and you have your trend line here. And once it breaks that trend line, you could put in a short sell, or you could wait to break out the neckline here. So this is just another example of a cup and handle here. You can see that the price is in a steady uptrend and eventually gets sold off here. And you can see the calendar under here, like February, March, April, May, June, July, August, September. And you see that the price is breaking downwards, consolidating, and then eventually it's starting to move back up again to form the cup. And again, then price then consolidates and kind of drifts downwards, forms the handle. You draw in your trend lines there. Once it breaks the trend line, then you can see that the trend then continues. So it's a bullish pattern, but it's also known as a continuation pattern. So as you can see that it was before it put in the cup, the price was moving upwards in an uptrend. And after it broke out of the handle, it continues its uptrend. As you can see in this chart here, right, this is once you get good at this, and you'll see it just becomes very easy for you to spot patterns in charts. So, for example, here in this cup and handle, you can also see that there is a head and shoulders. So this would be one shoulder right here. This would be the head, and this would be the right shoulder. So in theory, this is a chart that this would be a chart pattern within a chart pattern. And you'll see this time and time again, especially in reversal patterns. And reversal patterns are my favorite type of pattern to trade. Because moving on now, you'll see other ones like bilateral patterns. It's very 50-50. It's very hard to judge which direction they're going to go. But I'll be explaining that more in detail towards the end of the video. So here we have rising and falling wedges. So wedge patterns are basically two converging lines that are either in an uptrend or a downtrend. So a rising wedge would be in an uptrend. So you'd have you'd have higher tops and even higher bottoms. So you're seeing the convergent lines here, and it's forming a wedge pattern. So as the price bounces off each trend line, it gets tighter and tighter and tighter, and eventually it has to break. So a rising wedge is usually a bearish pattern. So it has a higher probability of price breaking downwards. So a falling wedge then is usually known as a bullish pattern. So you'd have even lower tops and lower bottoms. So price is breaking downwards, and you can see the two converging lines here. The price is getting squeezed. It's getting tighter and tighter and tighter until it breaks out. So they say it's like 69% of a chance of a falling wedge breaking upwards, and a rising wedge is what they say is it's 69% chance to break downwards. So just always remember, a rising wedge is a bearish pattern, as there's a higher probability of the price breaking downwards, and then a falling wedge is a bullish pattern. So there's a higher probability of the price breaking upwards. Now, by no means these patterns are a guarantee. As I said before, it's just a higher probability. So here is an example of a chart where you'd have falling wedges and rising wedges. So even though it's in an uptrend, you still can have falling wedges and rising wedges in an uptrend. So as you can see, the price is moving upwards to a point where it breaks down, forms a falling wedge. The price gets tighter and tighter, tighter within the trend lines, and eventually breaks upwards. And again, here you have another falling wedge. So the price is still in uptrend, but forms a falling wedge, gets tighter and tighter and tighter, and it breaks upwards. So as you can see that a falling wedge is bullish, a rising wedge is bearish. So here you have a rising wedge, price is getting squeezed in between the trend lines, eventually it has to break, and there's a higher probability of breaking downwards. So it's a bearish pattern. And again, you have another rising wedge here where price is just getting squeezed in between the two trend lines, and it breaks down again. Remember, you need at least 2 touches on a trend line to form a trend line. 3 is a lot better. If you forget that, remember I have made a previous video on trend lines and how you draw them. So you better check that out if you forget or if you haven't seen it already. So here are some examples of bilateral patterns. So again, when I say bilateral, that means that the price action can go either way. So it's pretty much 50-50 probability. So here you have ascending triangles. So where you have the price is hitting resistance. So this line here would be the resistance, breaks back down, but it's put in higher lows. And as you can see in this chart here, it breaks out. But in this one here, you can see that it actually breaks downwards. So this is like your resistance line. And this would be your trend line when plotting in the higher lows. So then you have the flip side, you have the descending triangle. So you'd have the horizontal line would be acting as support here. So the price is bouncing off support, putting in lower highs. That gives you your outer trend line. And in this example here, the price actually broke upwards, but it did the opposite here in this diagram where it actually broke downwards. Then you have symmetrical triangles. So symmetrical triangles is you have price forming some kind of a flag. It's more so in like after big moves, it goes into a symmetrical triangle, and it's consolidation, and it just bounces up and down off either trend line, and it has a 50% chance of breaking upwards or a 50% chance of breaking downwards. So just remember that bilateral patterns, it's a 50-50 chance, and it's normally, some people say it's like just when price goes into consolidation. It's usually happens after a big move in the market, whether to the upside or the downside. So I thought I'd just add in this pattern as well too, because I do quite see it quite a lot. So this is the Bart-Simpson pattern. So you have the positive Bart or the negative Bart. So what is a Bart-Simpson pattern? So the positive Bart pattern is the head with the correct position. This kind of pattern is lacking the volume to push the price upward. It then drops significantly due to the lack of volume trading. So a negative Bart then would be, the negative Bart pattern is the upside down head. This kind of pattern is when the market sells sharply, but realize that the price is too cheap when suddenly buy back to shoot up the price more than before. So usually when I see these type of patterns, especially when it shoots up really quickly and it consolidates, straight away I can see it, and I'm very aware that price can suddenly drop downwards. But yeah, I do see this quite a lot, and I'm sure you will as well too. So there you have it, folks. There is the video on chart patterns. I hope this is starting to make sense to you. And if not, if you're having trouble, just explain to me what in the comments below, and I will try to address each comment. And I appreciate you watching these videos. Please do me a favor, if you haven't already, go down, hit the like button, hit the subscribe, and I will see you in future videos.